Are we on the brink of another market rally? Or is the S&P 500 about to face a downturn that no one sees coming? 2024 was an exceptional year for investors, marked by unexpected resilience in the face of rising interest rates, geopolitical tensions, and fears of a global slowdown. Now, as we enter 2025, the big question is, where do we go from here? In this video, I'll break down the key drivers shaping the market right now, analyze where we are in the market cycle, and outline practical strategies you can use to position yourself for what's ahead. Welcome to Sage Investing, bringing you timeless investing wisdom. If you're looking to improve your investing knowledge, make sure to subscribe and hit the like button if you found this useful. Let's start with the bigger picture. The S&P 500 finished 2024 strongly, up around 23% for the year, an impressive feat given the headwinds it faced. But the rally has been uneven. Much of the gains were concentrated in mega-cap tech stocks, while small caps and other sectors like utilities struggled to keep pace. This divergence tells us something important. The market isn't fully convinced of a broad-based recovery yet. Now, where are we in the market cycle? To answer that, we need to revisit 2022 and 2023. 2022 was a textbook bear market, declining prices, fear-dominating sentiment, and valuations compressing as the Federal Reserve aggressively raised interest rates. In 2023, we transitioned into what many analysts call the hope phase, a recovery driven by expectations that inflation would cool and the Fed would eventually pivot. But here's the thing. As we enter 2025, we may be approaching the optimism phase, where markets start pricing in sustained economic growth and stronger corporate profits. Beyond this phase, however, lie the next three stages in the classic market psychology cycle: belief, thrill, and euphoria. These stages are where the danger really begins to build. In the belief phase, investors start thinking, this rally is real, and they pour more capital into the market. This optimism can feed into the thrill phase, where people begin to feel unstoppable, saying things like, this is the best investment decision I've ever made. At this point, the fear of missing out takes over, and capital flows into increasingly speculative assets. Then comes euphoria, the most dangerous stage of all. This is where valuations become disconnected from reality. Everyone seems to believe the market can only go up, and phrases like "this time is different" dominate the conversation. Historically, this is where the largest risks are taken, leverage skyrockets, and latecomers pile in just as the market reaches its peak. When everything looks rosy, people forget the fundamentals. Risk management gets ignored, and investors hold on too long, believing prices will never fall. But history tells us otherwise. Euphoria almost always precedes a market correction or crash. As we move through these phases, it's crucial to remain grounded. Remember, markets are cyclical. What feels like unstoppable momentum today could quickly reverse tomorrow. Avoid getting swept up in the emotional highs and stay focused on your strategy, especially as we transition through these volatile stages. So where are we today in early 2025? Right now, it feels like we're transitioning between the hope phase and the early stages of optimism. The S&P 500 has recovered strongly since its 2022 lows, and investors are finally starting to feel more confident about the future. Inflation is down, corporate earnings are improving, and the economy has shown surprising resilience despite elevated interest rates. But it's important to note that we're not fully in the optimism phase yet. The market is still showing signs of caution. While large-cap tech stocks have led the way, other areas of the market, like small caps, financials, and even parts of the energy sector, are lagging behind. This suggests that not all investors are convinced this rally has legs. Another key indicator is sentiment. If we were firmly in the belief or thrill phases, we'd see extreme greed dominating the headlines. Instead, we're seeing a mix of skepticism and cautious optimism, which means there's still some room for the rally to grow if the data continues to support it. At the same time, we have to acknowledge the risks. The market is at all-time highs, valuations are elevated, and the Federal Reserve has made it clear that interest rates are unlikely to be aggressively cut at this moment. This creates a delicate balancing act. If economic data continues to come in strong, the market could push higher. But any cracks, whether it's a slowdown in earnings, geopolitical events, or a surprise resurgence in inflation, could quickly derail the optimism. Now let's talk technicals. The S&P 500 is currently trading around the 6,000 level, an impressive recovery, and now well above the previous all-time high of late 2021, which was near 4,800. This breakout has already shattered a major psychological barrier, and the market is firmly in uncharted territory. If this momentum continues, we could see a further wave of buying, fueled by optimism and technical trends. Key areas to watch are the round number milestones, like the 6,000 level, which could act as a magnet for prices if bullish sentiment persists. However, on the flip side, failure to hold this level could signal a loss of momentum and send the index back toward its nearest support zones. The first key area to watch is the 5,500 level, followed by the 200-week moving average, which currently sits closer to 4,500. Anytime the S&P has touched or dipped below its 200-week moving average has signaled an amazing time to accumulate. Right now, while the technical picture looks bullish, it's important to stay alert and be ready for some volatility as the market moves through these higher levels. The S&P 500's forward PE ratio is currently at 24, down from 25 last quarter, and a significant drop from 28 1 year ago. That's a decrease of about 4% from last quarter and 16% from a year ago. Historically, the average PE ratio has ranged between 16 and 18, so at 24, the market is still priced above its typical range. While the valuation has come down from its peak, it suggests that stocks remain relatively expensive. If rates stay elevated, this could put pressure on further price growth. So is the S&P 500 overvalued? The truth is, it depends on your perspective. If you're focused on short-term risks such as higher rates and slower growth, the market may look expensive. But if you're a long-term investor, the S&P 500 has historically proven to be a reliable compounding machine over time. If you're a long-term investor, this is where dollar-cost averaging comes in handy. Instead of trying to time every peak and dip, just keep investing a set amount regularly. It takes the pressure off trying to predict the market's next move. Even at these highs, DCA helps you stay on track with your goals without getting caught up in the short-term noise. Timing the market is tempting, but it's time in the market that really matters. So, what's the bottom line? The S&P 500 in 2025 is a market at a crossroads. With strong earnings expectations, easing inflation, and resilient consumer spending, there's a case to be made for further gains. But risks remain. Higher rates, geopolitical tensions, and the possibility of an economic slowdown could derail the rally. For now, the key is to stay flexible. Watch the technical levels, monitor the macro data, and don't lose sight of your long-term goals. The market is unpredictable, but preparation and discipline will always give you an edge. Thanks for watching, and I'll see you in the next one.